Hello, MBA 503 students. This is the final video, and I think they've been relatively short, between 15 and 20 minutes each. This is the final video in the series on financial statement ratios, analysis of ratios. Okay, so I'm going to get right into this. Okay, and we'll be finishing the ratios for Pfizer as we go through. Make sure I have the right sheet here. I do have the right sheet. So what we're looking, there's three ratios, and I'll just go ahead and telegraph here. There's three ratios for accounting return. These are all going to be accounting return ratios. Now, these ratios, they don't really tell you much about how a company is doing it for its shareholders, because that has a lot to do with the market. We'll tell you more generally, in general terms, how a company's performing, both for shareholders and creditors. Well, both for both shareholders and creditors. Okay, let's start with the first of these ratios. You're going to see, I'm going to tell you something here. There's first one is return on assets, and the second one is return on shareholders' equity. Return on assets is ROA, and return on shareholders' equity, I'm just going to give you the acronym here, is RSE, return on shareholders' equity. Okay, and I'm going to save that and then go to the slideshow. Okay, and so we will go to the slideshow, starting with return on assets. Now, these are all based on the financial statements. There's no market data in here like share price. Okay, so what we're going to do is we're going to be looking at, didn't even touch anything. We're going to be looking, the first ratio is return on assets. Okay, and ROE, look at the equation there. ROE on top has net income. That's the main number, net income. Okay, on the bottom, we have average total assets. So basically, it's net income over average total assets. We're going to make a small adjustment for net of tax interest. And where you see net income plus interest expense times 1 minus the tax rate, the interest expense times 1 minus the tax rate is the interest expense you paid net of taxes, keeping in mind that interest expense is most likely deductible. Okay, so basically we're going to have net income adjusted for interest expense, and then we're going to add to that average total assets. Now look at the description I have here. This ratio measures the return to all investors, including both creditors and shareholders. It's on the bottom, you have total assets. Keep in mind that assets are equal to, and that's what I say in the parentheses there, keep in mind that the assets equal the sum of liabilities and shareholders' equity. So here you have it, is your base includes both shareholders and creditors. That means all investors. And on top, we have basically net income. And we add back interest expense. We add back interest expense because we're trying to measure our pre-interest and tax net income from operations. And keep in mind that income would be available, the pre-interest income would be available to pay both interest and dividends. So we kind of have to add that back. And that's the one adjustment I was kind of referring to in one of the times interest earned, I believe. But we're going to make that adjustment now. Okay, for this ratio. Okay, so let's go to the worksheet here and see how this comes in. So net income after taxes. So this is equal to, and I can use numbers that are already in the worksheet. We know that your income was used in the earnings per share calculation. Okay, so that's our base number. Then we're going to add back interest expense. So we're going to add back, we know that we used interest expense times interest earned. We're going to add back interest expense. We're going to multiply interest expense times 1 minus the tax rate, which we calculated initially. The tax rate, that's why I do these initial calculations all right there. So the interest expense times 1 minus your tax rate gives you your net of tax interest expense, or you're adding back income that you added back on your tax return for interest expense. Okay, so, but still our base number is taxes, and we do get, I don't know if it came through. Yeah, it came through. Okay, 17,723, and notice the number isn't too different from the 16,273 income. We just added back the net of tax interest. Okay, now your average, I should put here, the label is fine, but I'm going to emphasize average total assets. Now, we're going to be using eventually operating assets here, but we'll start simply average total assets. Okay, so your average total assets, like I keep saying, averages are the beginning balance plus the end balance divided by 2. So here's what we're going to do. We're going to go over to the balance sheet, which I always put right to the left here, or exactly to the left. Okay, so we're going to take total assets, your beginning total assets plus your ending total assets right there, and that's all divided by 2. Okay, so it should come in. That looks about right. Okay, and so let's see what this corporation on an accounting basis is returning to all its investors. We take the 1723 divided by total assets, 10%, 11%. Not bad, not bad. RSE, the return on shareholder equity, is going to be interesting. Okay, so I'm going to say Pfizer is, on an accounting basis, is returning, I'm going to put in parentheses here, on an accounting basis, 10.84% to both creditors and shareholders, both types of investors. So, and I'm going to change this. I'm going to go ahead and reformat this just to make it plain. I'm sure everybody knows about percentages, but just to sort of make it better here. Percentage, terrific. Okay, so this means that if, as a mixture, this company is returning close to 11%, your company is returning close to 11%. So this looks pretty good overall. Okay, now this return on shareholders' equity only measures the return to shareholders. We're leaving creditors out. And so keep in mind, like I said in the slide, since this is average total assets, assets are equal to liabilities plus shareholders' equity. What we're doing here is using only shareholders' equity. So the difference is going to be average liabilities. We're pulling them out here. Okay, and this ratio is always higher than return on assets. So let's start with the numerator. Okay, and net income will be 16,273. Once you've used the number, just bring it on down. And your average shareholders' equity, like I said, any average is the beginning plus the ending all over 2. We'll go to the balance sheet. Shareholders' equity is always on the balance sheet. And then, okay, so we're going to take the beginning shareholders' equity. We're going to put that in parentheses. And then we're going to add to that the ending shareholders' equity, which is that number right there. And put that, oh, wait a minute. Unfortunately, I'm using the wrong row there. Go back here quickly. So let's do this again. We're going to take the shareholders' equity, the beginning shareholders' equity is that number right there, plus the ending shareholders' equity, which is 63,447. And we're going to divide them by 2. That looks about right. So let's see what our return on equity is. We're going to take that number, that income, divided by average shareholders' equity, 25%. You'll notice that I'm going to format this here first. Get this cell formatted. Percentage is what we want. That looks pretty good. 25.59%. So I'm just going to go ahead and copy this sentence down to here. So I'm just going to copy this down to here and say that Pfizer is returning on an accounting basis 25.59% only to shareholders. Okay, and that looks pretty good. So if you have a share of stock in this company, and you probably do in Pfizer, is this, you're getting a 26% accounting return to shareholders' equity. That's not bad, but look at the difference between return on assets and return on shareholders' equity. And this is something I'm going to be asking you in the class as we go along here. Why do you think there's such a large difference? And I'll tell you, well, I'll hint at the answer. It has to do with the amount of debt they have. And remember, the return on assets ratio, this has both creditors and shareholders in the denominator. I'll even make that bold and red. And this one only has return to shareholders. So this is only return to shareholders. Okay, and the difference is not in the numerator. Now you could argue that they're different, but basically they're both net income. The difference lies here. The difference lies in the debt. Okay, and if you take two companies and they're exactly the same, their asset levels are the same, they have the same amount of assets, but their mixture of finance and the mixture of liabilities and equity is different, then the more debt you take on, the higher the difference. So if Pfizer used the same assets but took on more debt, this 25%, the 10.84 would be the same, but the 26% here would go substantially higher. So the higher a company's debt, especially long-term debt, the larger the difference between these ratios will be. Okay, and once again, these are used to make general comparisons with other companies in the industry, which we'll do when we look at Merck. I'm telegraphing a little bit here. Now, the final ratio is incredibly important, and this frustrated me a little bit about Pfizer's income statement in that it did not have a separate line for gross profit. So gross profit should be a separate line item in the income statement. Then we could just pull it off and divide it by total sales. Okay, but let's see what we get. We'll have to go over here to the income statement, and I'm just showing you, I'm doing this to show you. You'll notice up here that they have revenues, and then they just lump cost of sales in with everything else. They should have a separate line for gross profit. So what I'm going to do here is I'm going to compute 2019 gross profit. They should have a separate line for that. And gross profit is just, like I said in another video, revenues minus cost of goods sold. Okay, so in this case, gross profit, I'm going to put it here. Gross profit is equal to, I'm going to say here, this is 2019 gross profit. There should be a separate line item right in here for gross profit. Okay, and I'm just going to say it's revenues, and it's going to be minus cost of sales. I'll spell it all out for you. We usually just say cost of goods sold, COGS, COGS. Okay, so for now, I'll spell it out for you. Okay, so gross profit, that is going to be equal to gross profit. It should have a separate line item for this. Okay, so revenues are 51,750. Your cost of goods sold is 2019. So the total gross profit here is going to be 71,750 minus 2019 gives you 41,531. Okay, and I'll make sure to save this worksheet here. Okay, so we've got our gross profit. So if we go back to the ratios, okay, and gross profit percentage, gross profit, the numerator is, now it gets easy. The numerator here is the gross profit that we just computed. Gross profit is that number right there. Total sales is equal to the top of the income statement. We'll go to the top of the income statement, which is that number right there. It's equal to the same number I used. So your gross profit percentage is, that's a tremendous gross profit. And this is, 80% of gross profit on sales. So this means that in basic profit, that for every dollar sales, they make a gross profit. Your company makes a gross profit of 80%. Now, I don't know what the industry average is, but we're going to compare it to Merck. And it really looks like, this is a tremendous gross profit. Now, what's happening, it seems like to me, is that the company is making a really big gross profit. And from there comes a lot of cash. And what they have is a lot of cash, which they can pay out as dividends, which means you're going to get the high dividend payout ratio right there, 50%. Okay, so now I'm beginning to see that your company at this point, I would say, at this point, this could change really quickly, but at this point, it's a relatively slow growth company that pays out a lot of dividends, which is not a bad thing, absolutely. Okay, so let's go ahead and change this to a percentage format. So 80.25% is great. So I'll put a little explanation here. Pfizer is returning a gross profit of about 80 cents. So I'm going to put here 80 cents for every dollar of sales. And that's huge because if you think, I know Apple's in a different industry, but I'm just making a generalization here. Apple in its prime back in 2012 was returning a 60% gross profit. Of course, it was growing faster than Pfizer stock, which gave everybody great returns, but paying an 80% gross profit, having an 80% gross profit percentage, gives it, my prediction is it gives it enough cash to have a high dividend, a payout ratio of 50 cents on the dollar. Your company's paying out 50 cents for every dollar it earns, which is half of its earnings. And I'm going to change this, reformat this. And it is, this should be dollars actually. Oh, percentage is fine. You can always put dollars. It's 49% of earnings per share, or close to 50 cents of dividends of each dollar. So this high gross profit enables Pfizer to have both high payout and high dividend yield. We'll get to more of this when we look at the statement of cash flows. But anyway, so that's what it means. And I'm just going to go back to finish the slide here. And let's see. So the last ratio was, let's see, return on assets, return on shareholders' equity, and finally gross profit percentage. That's what I just did. But it's very easy. Gross profit percentage is just gross profit divided by total sales. This is a basic ratio for any manufacturer or retailer. You always want to get the highest gross profit you can. Now, gross profit, it's also called gross margins. And the final sentence here, this is why I want to come back here, a principal factor which affects gross margins is the price of a company's goods. If you can charge high prices, your gross profit and gross profit percentage or margin goes up really fast. The problem comes in is, for a lot of companies, is if the competition comes in or if their products become obsolete, the price they can charge goes down. And that also means that the gross profit margin goes down. And Wall Street really, really looks out for that. Anyway, this finishes these videos, and I'll go ahead and post this one to YouTube too. This one should have been the short, or may have been, I don't know how short or long it was, but I was more to the point here. Anyway, I tried to be, anyway, so I hope to see you on Tuesday, and we'll see each other on Tuesday. Anyway, so happy accounting.